Yes, a very warm welcome to the autumn session of the Financial Fitness Fridays. We've got so much to cover today. I'm not going to do too much of an intro. The bottom line is we're going to be covering today. Firstly, we're going to look at fixed rate mortgages. I think they're very topical at the moment because a lot of people are coming to the end of their term and getting a bit worried. We're going to cover some bits from the autumn statement. It does bring with it some opportunities, so we're going to discuss that. And there's a big debate going on at the moment, so I had to bring in a particular specialist on this one. Cash is doing rather well at the moment because interest rates have gone up, whilst investment markets have sort of flatlined for a while. So we're going to talk about that debate. Without further ado, and apologies for the technical glitches, not quite sure what's going on there. Could I introduce Colette and Jamie? They're two advisors from our organisation. Hi, Colette.
Hi.
Hi, Jamie.
Good morning, Darren. Good morning. And as it's the 1st of December, happy Christmas as well.
Oh, you've got that in there first. Terrible. Oh, no, yeah. My wife's already done the trees and the decorations. Look, I'm not going to spend too much. What I will do today, I tend to very much focus on all of this from a financial well-being perspective. And, and 80% of financial well-being is it's a psychology about this. It's our mindset. And good financial well-being means we don't feel stressed about money. And the things that cause stress is feeling out of control. The things that we can do to take control is taking the right actions, right habits, the right behaviors. But the other element is what we're going to do today is to have relevant knowledge. And also delivered in a way which is enjoyable and engaging. So it's the relevant knowledge. So if we've got more information about things we need to know about, we feel in control, good for our financial well-being. So I'm going to get cracking straight on. The first question is for Jamie. And that question is, look, sorry, not for Jamie, sorry, forgive me, Colette. Fixed rate mortgages. I'm hearing it a lot. We do a lot of work with companies and their staff when it comes to financial well-being. There's a lot of people who've got the fixed rates coming to an end. They had it very, very, very low. They're going to go up 2- or 3-fold. So what's the market looking like at the moment, Colette? Is it getting better? Is it coming down? What sort of products and deals are out there?
Well, the deals that are available at the moment really depend on the client's circumstances, and they can vary considerably from one person to the next person. I'm seeing rates of around about 5.4% at the moment for a 2-year fixed rate. And if somebody's looking for a predictable monthly spend, if that's really important to them, then you might want to consider fixing your rate, for example, based on what's available to you at the time.
Yes.
I think when you start thinking about your mortgage and potentially remortgaging or finding a new property, and your fixed rate term is coming to an end, the best advice I can give is to get in touch with a mortgage advisor. You can also speak directly to your lender and see what they're willing to offer you.
Thanks very much for that, Colette. So is there something, for example, that best deal, what's the characteristics of that applicant? What do they need to look like in order to get that kind of deal?
A regular income.
Yeah.
It would help if somebody had already had a mortgage, and they could potentially look at remortgaging a property, or perhaps purchase, if they're purchasing another one. It would just help if they have all of the information available. They've got a really, really solid track record in terms of their credit, and they need to spend some time with a financial advisor to talk through all of these requirements. And each lender is slightly different from the next, so it's a case of figuring out what's available to you.
Yeah, I think I over the years I've picked up on it's false economy to try and do it yourself.
Yeah,
about it. Someone's doing it all day, every day for a living. They're far better qualified, and it might be a small cost involved, but it's definitely a good investment to make sure we get the right deal. And I think also fixed rates, I like them because from the financial well-being angle, because there's things we can't control. We can't control government legislation, right. Interest rates. We can control a fixed rate. If we can get 2 years or 3 years or 5 years, we have that element of control. It's really good for our soul. We don't worry what's going to happen. Every time the news comes on, we're going to be paying more mortgage. So from that perspective, a financial well-being perspective, it's a brilliant thing. Yeah. So for those people that, there's not much option, they're going to have to increase their fixed rate cost, their interest rates. Is there anything else they can do to help make that monthly payment more manageable?
There's no easy solution for this, right? It really is down to that particular individual, but there are things that they can do. So, you could consider extending the term of your mortgage, which could reduce your current monthly repayment value. You could consider downsizing or using, a big chunk of your savings to pay off your overall loan. You could look at other ways to kind of, reduce your monthly expenditure, all of your monthly outgoings, and just increase the pot on the other side, if you like. And there may be an option available to you to switch to an interest-only mortgage, which would reduce your monthly payment. Whatever your circumstances, you've got to talk and ask for help, and the person that's in your corner is obviously going to try and do their very best to meet you where you are. And that's there are things you can do. It's just a case of having a look at what you've got and what you want, and try and figure out your way through that whole conversation.
Yeah, so sort of there with saying, look, spread the cost, make it for longer. That'll bring the cost down. The interest-only thing, is that quite popular? Was there any dangers to that, the interest-only option?
It's there are not many lenders that will let you do that off the bat. Right. So you may be restricted in terms of what you can do there. Interest only means that you're just paying the interest on your loan, so you're not paying off any capital. And some people are not comfortable with that. There would need to be some kind of investment a proposal available to pay off your mortgage at the end of that, which is what a lender would ask you for, like an annuity fund or some kind of insurance.
Yeah, brilliant. I think also, going back years ago, I mean, I've been doing this for far too long now, but everybody had their mortgage finished by 65, but those things have changed now. We're all expected to live a lot longer, retirement's a lot less. So there is opportunities there so I think the message you're saying is, look, don't panic. Yeah. Get professional help. Talk to someone that knows what they're talking about. Look at it a bit more holistically. Look at if there's two of you, then look at your budgeting. Look where else you can shave some costs off. But actually, step towards it, walk towards it. Don't run away from it. There are ways you can actually get that into a more manageable situation, and still have a comfortable life.
Yeah, absolutely.
Brilliant. Thank you very much for that. Okay, look, I'm going to ask Jamie a question. So, look, we had the autumn statement. Obviously, when there's an election looming, there's often giveaways from the incumbent political party. There was this time, obviously, they're sort of boasting about making reduction. Now, one of the things they talked about was reducing national insurance, which is a kind of a tax, isn't it, from 12% to 10%. But also doing it in January, which is rather quicker than usual. It normally comes in the new tax year. So I guess that's got something to do with the election. Who knows? But what does this look like in practical terms, Jamie?
Yeah, as you say, Darren. Yeah, it's at a time when, as we've just talked about, everything seems to be going up in price, and mortgage payments are rising, and all the rest of it. And even if you look backwards a few years, we've effectively had lots of tax rises. This is really welcome news, because it is effectively a tax cut. And as you say, it's a sweetener from the government to try and get a few more votes in the run up to the general election. So national insurance, as you say, has been cut by 2% from 12 to 10%. But what does that look like in terms of, people's pockets? Well, if we take a couple of examples of income, if you look at an average worker earning £34,000 to £35,000 a year, they would effectively be £450 a year better off, which is the equivalent of just over £30 a month. And if we look at a worker earning £50,000 a year, they would be about £60 odd a month better off. So I think a meaningful amount of money, and as we said, that'd be welcomed by lots and lots of people, seeing their cost of living increase. And I'm not naive enough to think that that many people will be able to put that money away and save it. But for those who are able to afford to do so, they might want to think about saving a little bit more towards their longer term goals, perhaps redirecting 1 or 2% of that tax cut into their pensions. We know that's the most tax efficient approach to saving over the longer term, even saving into an ISA, or for those just on that at the start of that savings journey, perhaps just saving into cash. That's really important. We've talked before about building up a short-term cash fund there for emergencies when people need it. Or, as Colette just mentioned, you could even think about overpaying on your mortgage. And I think that the question that people might want to just ask themselves is, could I live at the moment on 98 or 99% of my income? Most of us could do without that 1 or 2%, and saving that for the long term just might lead to a more meaningful, certainly a better outcome for those at retirement.
Yeah, I think it does bring an opportunity. So if I go back to the late 80s, early 90s, when I first started out, I was dealing with lots of young people then, and there was a lot of people out in our industry persuading people to save, which wasn't a bad thing. The habits were good, the products weren't so good, but the habits were good. And I used to see these people with once or twice a year, but would often do it when there was a change of tax year, when tax codes went up, and there was some change to tax, where they saw their take-home pay go up a little bit, and catch them at that moment, but focus on why they're saving, go back to the why, and then come back to the how. And the how is, well, I'm going to be £30 a month better off. I've lived for last year without that. That's a really perfect opportunity to switch that into savings and start to create those better habits. I have actually seen what happens to people who do that, 30 odd years down the line. I've seen the different outcomes for people because they get into habits. And it's less about them being big earners and great investors. It's more about them being consistent savers. And that's the real game changer. So it does bring with it a really powerful opportunity to get into some good habits, even if it's just a little bit. It's a little step in the right direction. So if somebody isn't saving right now and you're 30 odd pounds a month better off, £1 a day, let's call it, let's maybe redirect it. We don't notice it. Let's start that process in a positive way. Okay, there was another thing that they mentioned in the autumn statement, I think worth mentioning. It was just trying to understand the new changes to ISAs. So a couple of things is, could you just explain what an ISA is to those that don't know in very simple, plain English terms? And then could you articulate the introduced changes and the benefits to savers of the new legislation?
Yeah, so firstly, in very simple terms, an ISA is a tax-efficient savings wrapper. So what that means is the amount of money that you save into an ISA, the returns on it are free from any income tax and any capital gains tax. And so that means you can take your money or withdraw it from an ISA without any tax liability at all. Now, there are some limits on how much you can pay into an ISA each year. That's £20,000 per person. And importantly, you can only have an ISA in individual names. So you can't have them in joint names or anything like that. ISAs have actually become a little bit more complicated. I was thinking about this the other day. There's actually now 5 different types of ISAs, and I won't ask you to tell me what they are, but it does make it a little bit tricky for people to choose which ISA is best for them, and they've all got slightly different purposes. They're designed to do something slightly different, but it's something that people might want to think about. Now, as you mentioned, there are some reforms that are coming into effect from April next year, and primarily these are designed to encourage people to save a bit more into ISAs, so to save tax efficiently, and a bit more flexibility. There's several reforms, but the two I think are the most sort of meaningful, or the ones that have the biggest impact, are the fact that people can now save into multiple ISAs in a tax year. So as I mentioned, there's 5 different types of ISAs, and now you can save into different types within the tax year. So for example, you could save £5,000 into your cash ISA and £5,000 into your stocks and shares ISA. And prior to these changes, you could only save into one or the other. So you'd have to choose between the two. So I think that's quite a welcome change for people, because people may say, I want to save, for example, both for the short term by saving into a cash ISA and the long term by saving into a stocks and shares ISA. The other main change is around partial transfers. And if you have an ISA, you can transfer them to different providers, if it's a cash ISA, for example, to different banks or building societies, to try and get the best savings rate you possibly can. We know that they tend to change from a bank to bank. And now you can do partial transfer. So if you have an ISA, let's say again it had £10,000 in it, prior to these rules, you'd have to transfer the whole pot to your new ISA provider. Well, now you can leave, for example, half the pot where it is and just do a partial transfer of the remaining 50% to the new ISA provider to try and get better rate or whatever it might be. So as I said, those changes coming into effect from April next year, and I think they're really welcome. And I just want to encourage people to have a look at the different types of ISAs and consider what type of ISA might be best for them.
Brilliant, thank you. Can we just touch on the thing there? I think the language on ISAs is pretty poor. We either have a cash ISA or a stocks and shares ISA. I don't think that was anyone that's got a marketing background who came up with those titles. What I've found over the years is that for people who can't afford to talk to an advisor, they just read it literally and they feel a bit nervous to go from cash to stocks and shares. It feels like a big jump from cash to stocks and shares. And therefore, what tends to happen is most people for many years have taken the cash route because it feels safer. So that wasn't one of the set questions, but I just want to, I think we've touched on that. So could you describe what a stocks and shares ISA looks like? Is it comparable to anything else out there?
Yeah, so I think what we need to separate is the ISA wrapper from the underlying investment or what you're saving into. So an ISA wrapper is basically a set of tax rules. So those tax rules, as I said, determine how your savings within that ISA wrapper are taxed. And we know ISAs are quite nice and simple. There's no income tax. There's no capital gains tax on any returns that arise from that ISA wrapper. So what you save into is actually quite important. You touched on there, you could save into cash, but we know that cash is a very short-term type of investment, because we know that returns from cash over a longer period of time are just not that great. They tend to be even less than inflation. So the returns from your cash savings don't keep pace with increases in the cost of living. So the alternative for people who want to grow their savings over the longer term, and let's put some context around that. Let's say their longer term is 5 to 10 years plus, should look at saving outside of cash. And that means saving into stocks and shares, as you call them, the financial markets. And those can seem quite daunting, quite scary for people, because people typically associate that with a level of risk, perhaps the fear of losing their money. But I think it's quite important to understand how financial markets work. And if we look at a long period of time, we can say with quite a degree of confidence that returns from stocks and shares are far superior to cash. And that's why, as financial planners, we always encourage people to look outside of cash where they are saving for a longer period of time, particularly if they're saving for retirement. They've got that 5 to 10 year plus investment horizon. And our role is to help them choose an area of stocks and shares that they feel comfortable, because, risk, there is a spectrum to it. You've got lower risk investments that go up and down slightly in value, but obviously they don't reward you as much as those at the higher end risk, at the higher end of the spectrum, where you get more reward for taking higher levels of risk. So you've got to be comfortable, and it's really important that you understand what you're investing in, and that's a big part of what we do.
Okay, so just to clarify one key point there. So could we say that a stocks and shares ISA, the investment, it could be very similar to a pension fund?
Absolutely,
right.
Absolutely.
So that doesn't, we don't get put off saving into our pension, so therefore don't be put off saving into your ISA just because it says stocks and shares. That's the message there, I think. Okay, look, I'm conscious of time, so I'm going to crack on. The other thing that I wanted to ask you about is, obviously everyone's very interested in the markets. I mean, they've gone a bit flat for 18 months or so. I know you haven't got a crystal ball there, Jamie, but what are your thoughts about the current situation?
Yeah, it's a big topic of conversation when we meet clients. I think it's fair to say that people we work with are pretty fatigued. I remember the years leading up to COVID. It was a delight to meet clients, because we'd be showing them some really meaningful investment returns, and that made our clients feel great and made us feel good. And that's not been the case over the last couple of years, as you say. To understand what's going on at the moment, I think we just need to look backwards a little bit, because after the financial crash in 2008, 2009, what central banks did, like the Bank of England and the US Federal Reserve, is they lowered interest rates right to the floor. We went almost right down to zero. So when you've got interest rates right at zero, it means that investors have got no alternative but to invest their money. There's no point in leaving it in cash. So you invest your money, and therefore there was great demand for stocks and shares, and we had many years of the stock market and financial markets providing good positive returns for people. But we know that as a result of the pandemic, as a result of COVID, suddenly, governments and central banks had to step in to protect people's incomes, to protect businesses, and how they did that was by printing lots of money. We had a big increase in the money supply, and over the last year or so, we've seen the aftermath of that, which has been a rise in inflation. Where you increase the money supply, it inevitably leads to a rise in prices. And that was not a shock or a surprise, I think, for most investors. But what has caught us all off guard is just how sticky inflation has proved to be. It was expected to be quite sort of transitory, quite short-lived, but inflation has stayed around for a lot longer. And in response to that, central banks and governments have had to increase interest rates really quickly. And that's a big headwind for financial markets and stock markets. So investment returns have just been hard to come by. It's difficult to say when that will change, but I think most people would agree that generally the consensus is that the catalyst for a market recovery will be when investors expect interest rates to fall. So hopefully that will be sometime over the short to medium term, but we don't know. But never underestimate the power of the stock market to recover. History shows us that it always does. It always delivers better returns than cash. So as an investor, stay the course, be patient, and you will be rewarded for it.
You're already jumping into the answer to my next question. So because of time, I'm going to sort of segue into that. The big question that I'm hearing a lot is cash has come up. I mean, I think the interest rates have gone up 15 times in the last year or so. We can now get a fairly decent return from cash without the risk. We've seen the markets flatline. I've got a pension fund with £100,000 in it. The question I'm hearing all the time is, should I move that into a cash fund, or should I put it into cash for now? What's your thoughts on that, Jim? Is it cash or investments right now?
Yeah, well, I get this question quite a lot as well. And, let's face it, cash does look quite attractive at the moment. If you can get 5 or 6% as a risk-free return, that looks pretty good compared to what you were getting in cash only a couple of years ago when interest rates were down at 0%. You were lucky if you were getting 0.5% on your savings, and now you can get 5 or 6%. So why wouldn't you want to take that? Well, again, as we've mentioned, cash is still a short-term investment. We know that interest rates, for example, are not going to stay at this level forever. At some point they will fall, and we also know that over the longer term, even with interest rates at these kind of levels, the stock markets and the financial markets over the longer term will deliver a better return from cash. But what's more important is that it is a fool's game trying to time financial markets. So when you've got an investment in your pension savings, for example, and you choose to switch that into cash, you are effectively trying to time the market. You're trying to switch out of an investment into cash. And that's a very tricky thing to do, because do you know what? You've got to time the market not just once, but twice, because at some point you're going to have to switch back into the market, and it's almost impossible to time that moment. When do you know when the right time to switch back into the market is going to be? Often people leave it too late. They've mistimed the market and they've missed out on that market recovery, and just missing a few best days of financial markets can be really harmful to the longer term performance of your pension portfolio. So again, stay the course, stay invested, because if you're trying to time the market, the old adage goes, you know, it's not about timing the market, it's about time in the market. Stay the course.
Brilliant. Thank you very much, Jamie. Well, I've got quite a few questions coming through. So what I need to do now is I need to keep ourselves compliant with our regulator. I just need to do a screen share and just bring up the caveats. Those the people that are need to go, then feel free to go. Those that want to stay on for the questions, then please hang around for that. Let me just bring that one up. So can you all see that thank you and the caveats?
Yes.
Good. Right, that's done. Okie dokie. So those that need to go, thanks very much for joining in today. I hope you got something out of it. You know, the bottom line is, more information you have about your situation, the better your financial well-being, for sure. So I've got some questions. I'm going to start, because those of you that have got questions, please stick them into the chat function. Obviously, the Q&A is not on there. I don't know what's going on with this strange Zoom glitch today. We seem to have a gremlin in our system. However, I've got a question. This one's for Colette, actually. Question here is that, is it worth taking a mortgage on the variable rate now, as they might be coming down in the future, as opposed to going to a fixed rate? And the other question says, and what sort of rates are the best variable rates available out there?
Oh, good question. I think for a variable rate, obviously you stand the risk that the rate's going to go up as well as go down. So, you know, nobody has a crystal ball. If you were going to go for a variable rate, I think you would need to be prepared to deal with whatever the movement is in the market. And we are, as we know, sitting at a very, very high rate at the moment. So would you like to take that risk? Are you not better off fixing your mortgage, as we've discussed? I did have a look at what variable rates were looking like for a client the other day. And the best way for us to get a reasonable variable rate was to fix for the first period, so first couple of years, and then it went on to a variable rate. And I was still looking at about 5%. So it's for that fix. So it is something that you need to speak to your advisor about. You know, every single person has a different circumstance.
What's a typical difference between, you know, a good fixed rate and a good variable rate? What would be the typical difference between the two at the moment?
Do you know what, Darren? I haven't done enough research to answer that question for you.
Okay, no worries.
Yeah.
Okay, so question here for Jamie. You mentioned earlier on that there was 5 different ISAs. Questions come through here. Could you explain the pros and cons of a lifetime ISA?
Yeah, that's a great question. Yeah, the lifetime ISA is probably the more complex of the ISAs available. I think a lifetime ISA is primarily designed for 2 purposes. The first one is to help first-time buyers under the age of 40 get onto the property ladder, but they must be buying a property that's less than 450,000 in value. And the second purpose it serves for those who don't want to use their ISA savings to buy a property is for retirement. Now, the main benefit of a lifetime ISA is that with the money that you save into it, you get a government bonus of 25%, subject to a maximum of £1,000 per annum. So if you're saving £4,000 each year into your lifetime ISA, you get immediately applied a government bonus of £1,000. So again, it's sort of like pensions tax relief. It's free government money. So it's really attractive. And we know, in addition to that, your ISA savings, as we mentioned, are growing free from any income taxes or any capital gains taxes. So I think they're really good, particularly for those who are trying to save money over a sort of a long period of time, perhaps 5 or 10 years, and want to get on the property ladder. I think they're really well designed for that. And who doesn't want free government money, hey? So yeah, I'd really encourage people to look at setting one up. As I said, there are lots of conditions and lots of rules with a lifetime ISA. You have to be under the age of 40. Just a note on taking the money out. You can still access the funds in a lifetime ISA if you didn't want to use them to buy a house, for example, if your circumstances changed. But there are withdrawal penalties. So you would lose those government bonuses that have been applied, and you would incur an additional 5% withdrawal penalty on top of that. So effectively, you're going to end up with less than you put in, because not only have you lost your bonus, but 5% of whatever you put in has been deducted as well.
Right. Okay. Thank you very much. So another question here. This one's Colette. Because I think we mentioned that it makes sense if they got some professional help when they get a mortgage. Someone's asked, what's the typical cost for advice from a mortgage broker?
Oh, good question. You really need to chat to your mortgage broker. People charge anywhere between £95 for their initial consult to £1,000, depending on what level of service you're looking for from them. And there are various other costs associated with setting up your mortgage. But if you're looking for just that help to get yourself in front of somebody to have a conversation, some people will do it for a nominal charge. Some people do it for a little bit more. It just depends on who you're speaking to.
Brilliant. Okay. I suppose it also depends on how big the mortgage is and how complicated it is.
Correct.
As well.
Correct. So it's about level of service. Yeah.
I get a few people put their hands up. So I think this whole Zoom thing's letting us down today. I don't think everyone's got the ability to put questions in or let's have a quick look on the attendee list, see what we've got here, because I think there are people that are raising their hands and stuff. There's a hand raised here. So what I'm going to do, Bradley, I'm going to allow you to speak. So be brave. That might be the only way we can do that question. So I've unmuted you, Bradley. So if you'd like to ask your question. Or are you a bit shy? No, okay, Bradley's not going to speak. Again, it might be Zoom, it might not be you, Bradley. What a shame. What a shame Zoom's let us down. Sometimes it does that, doesn't it? It's a bit random. It's gone a bit weirdly. Oh, I've got another one. Let's have a look. I've got another hand up, so it might be somebody else that can't. Okay, let's go to Susan. I'm going to see if I can allow you to talk, see if that comes up. Susan, can you
Hello, can you hear me?
Yay!
I've got a question for Jamie. If I've got some money, am I better putting in premium bonds or a stocks and shares ISA?
Oh, that's a great question. I think, Susan, it really depends on what your objective is for those funds. So premium bonds is just another form of cash savings. So it's they're great for short-term objectives, as we've discussed. But if your objective, if you want to save for the longer term, you feel, for example, that you're not going to need to access those funds for a minimum of 5 years plus, then you can afford to look more longer term, and you may wish to look at sort of investing it into a stocks and shares ISA, for example. So really take it back to what you want those funds to do for you. Premium bonds, again, sounds pretty attractive. The average return from premium bonds at the moment is apparently 4.5%. I think it can vary. So if you look at a standard cash savings account, you can probably get a little bit more if you fix your money for 12 months or so. But if you don't need that money for at least 5 years, I would be looking longer term. As we've mentioned, the stock market has fallen a little bit over the last year or two. So if you can afford to look longer term, you might want to get in at the stock market when it's relatively lower.
Great, thank you.
Thanks very much. So we're going to give Bradley's got his hand up again. We're going to give Bradley another go here. So Bradley, I've clicked on the thing that allows you to speak. So
is that working now?
Yay! Hi there.
Sorry about that. Yeah, so I've recently just in the process of buying a property. All the legal fees and stuff are going through. So I've used my lifetime ISA on that. So kind of from a savings point of view, I'm kind of back at square one. I was just wondering what kind of advice you have and where I should be looking to put my money in from this point of view now, because I've always just put it into my ISA. So I don't really know from this kind of point forward where I should be looking to kind of invest.
Yeah, shall I pick that up?
Yep.
Yeah, thanks, Bradley. It's good to hear that you've taken advantage of the lifetime ISA and the free government money that we just talked about. I think it really depends. in previous sessions, we've always talked about the importance of maintaining an emergency fund. So an emergency fund should be equivalent of 3 to 6 months of whatever your regular monthly expenditure is. So if you're spending, sorry, £2,000 a month on your mortgage, your utility bills, etc., you want to have a minimum of £6,000 set aside in cash to cover you just in the event that the boiler breaks down or there's some sort of emergency at home. So that's the first bucket, if you like, that I'd look to fill up. Once you've done that, then you can look at the more medium to longer term. So you could look at, for example, if we look more longer term, saving more into your pension. And pensions are great. They're very tax efficient. And as we said, they're investing normally in the financial markets over a long period of time. The big disadvantage with a pension is you won't be able to access the funds that you save into it until you're 55, although that is the minimum pension age is rising to 57 from 2028. So as an alternative, if you still want to save longer term in stocks and shares, but you want access to those funds, then perhaps a stocks and shares ISA might be a good alternative.
Lovely, thank you.
Very good, brilliant. Thank you, Bradley. So we've got some time. There's another question come up here. So we've got Rajesh. I'm going to allow you to speak. So if you want to turn your microphone on and ask away.
Yeah. So my question is about when your pension does come to the point where you can get some access to it at the age of 55. I know it's not easy to answer this, but annuity rates, how does that work, and how much value do you need to get a good income, pension income?
Yeah, sounds like another one for me. Yeah, again, really good question. Annuities sort of fell out of fashion actually over the last decade or so, simply because annuities were pretty poor value for people. So if we look at someone who was age 55, for example, if they gave £100,000 of their annuity savings to an insurance company, what an annuity is it's an income for life in return for giving up those pension savings. And I'm gonna guess here that you would have been lucky to have got £1,500 a year from that insurance company at the age of 55 2 years ago. So, if you think about it, you'd have to live for over 50 years before you got any value from that transaction. But what we've seen recently, because interest rates have gone up, and they were, as we mentioned, at 0.5%, and now they're well over 5%, annuity rates are proportionate to interest rates. So as interest rates go up, annuity rates tend to rise. And at the moment, if you are sort of age 55, again, I'm going to guess, I don't have access to the market information in front of me, but you could probably get somewhere in the region of £3,000 to £4,000 a year income in return for £100,000 of pension savings. Now, that doesn't sound a great deal, because again, you've got to live for quite a few years before you get value out of it. But the other big factor in determining how much income you get from an annuity company is your age. So for people who are 65 or possibly a little bit older than that, they are looking at relatively attractive levels of income. I was looking at one yesterday for my client who is 65, and the rate that she could get is 7.5%. So if she gave £100,000 to an annuity company, she would get £7,500 a year for the rest of her life, no matter how long she lives. She's only got to live for 15 years before she sees value in that. That's less than the standard life expectancy. That is based on an annuity that doesn't increase each year, so it will stay level. It means that she only gets the £7,500 a year, but we're getting to levels that are much more attractive for people, and I think annuities are certainly should be considered by anyone who's approaching retirement and looking at their options.
Yeah, I think there's another thing to factor in here as well, and that is that once you've exchanged the cash for the annuity, you're not getting the returns on that cash anymore. That might be something which would be useful for passing on to families. If you've got children, there's nothing left to pass on with the annuity. Whereas if you had that money still invested and you were just taking an income from it, leaving it invested, if you didn't spend it all, there'd be something left. So one of the things that does put people off the annuities, if their situation means they want to provide for the children, and if they, let's say that they died 1 year after retirement, all that money's gone. And that was one of the things that people didn't like about annuities in the past as well. And that's one of the reasons it was changed to make things much more flexible. So this whole flexibility was brought into retirement planning. So there's lots of different options. And I think annuities are going to start to form a part of somebody's retirement portfolio, going forward. Now, we haven't seen them being used very much in the last few years. So I think the bottom line is their advice. I think hopefully today's shown people that doing all this stuff on your own is probably false economy. Most people that take advice are better off. It's simple as that. I mean, I know advisors are hard to get access to, and this Financial Fitness Friday gives people a bit of a flavour of that. You can ask some questions, you can have a listen to some conversation. That's great. I know that advisors are hard to find, but they are out there. If you want to get some advice, you can go to a couple of good websites. One's called vouched4.com, I think it is, and the other one's called unbiased.com. And I think what you can do in there, you can put in your location, maybe some of the particular topics you're interested in. It'll then filter down and find you a few. You can have some telephone conversations with them. You probably get an initial meeting for nothing, free of charge for a chat anyway, so you can kind of suss each other out. So, but I highly recommend, if you can, it's worthwhile thinking about investing in some professional help. These decisions are important. They affect our lives. It's probably definitely well worth getting some professional help. So look, we're done. Time's over. Thanks very much for jumping on, everybody. Thanks for jumping on board. We'll get this onto the YouTube channel. I think we've done about 25, 30 of these videos now. Obviously, time keeps moving on, so they get outdated, but this is the most current one up to date. So look, I want to thank Colette very much indeed for helping us out today. I want to thank Jamie for your brilliant investment knowledge. I love it. So it's been very, very useful. And I hope that people got a lot out of it. And it is December, so happy Christmas to everybody. Let's make sure we look after ourselves through Christmas. Don't overspend, because that January is the worst month in the year for financial well-being. So let's not end up in January with no money, load of debt and a load of worry. Okay, so be careful. You've got that little pay rise coming in January. Think about what you might want to do with that one. All right, thanks again, everybody. Take care.